I have been teaching finance for over 40 years and observing how companies actually put it in practice. I found that there are some really big myths about finance. They're so big that you wonder how they can possibly persist. So, the first myth that I want to talk about is the notion that profit is what matters. Wherever you hear companies, you hear investor calls, you hear public announcements, you hear about company boasting about becoming more profitable than it was before, that its profits have grown at so and so percent, and the fact that its earnings per share, for instance, have increased. These are things that they seem to think are important. The reality is that profit is not important. Profit is not something you can actually use to run a business. It is something you use to report, but it is not something you can actually use to invest, to pay your employees, to pay your vendors, to do anything with really. It's just a piece of paper. So, what really counts then? What really counts is cash. Cash is, in fact, the only thing that matters because cash is what you use to pay the bank, to pay your employees, to pay vendors, to buy machines, whatever it is. It has to be cash. So, unless you have cash coming in more than cash going out, you're not going to be able to survive and grow. Even growth is not possible without having cash. So, the first myth that needs to be exploded really is that profit is what matters. Profit is not important. What matters is cash. Here is a really salutary story. Long time ago in the US, there used to be a company called Commodore that was into gaming systems and so on. The slide here shows you the financials of Commodore. What you can see is that the company was doing well, apparently. It was growing well. But actually, if you look at the numbers, you can see that the company was not generating cash. It was generating more receivables and inventory than cash. In other words, most of its sales were actually being used up in things like inventories and receivables. In fact, more than the sales themselves. In other words, this company was destroying cash. The next year, this company went bust. Anybody who can see what is happening to cash would have been able to predict it. Unfortunately, the market could not. And it continued to be the darling of Wall Street. People kept buying shares in this company only to find themselves wiped out. To make matters worse, people keep talking about various forms of profit. We talk about earnings per share, EBITDA, gross margin, profit before tax, return on assets, return on investment, return on equity. All of these things are meaningless, actually, because none of them refer to cash. What really is the source, the reason why this profit has become so important wrongly in the world of finance? The answer is very simple and a strange one. The answer is it's because accountants are really, in some sense, they're philosophers, they're seekers of truth. And what they're trying to tell you is a true picture of what happened last year. The true picture of what happened last year requires you to do certain things, follow certain accounting rules, the result of which is this number called profit. It has nothing to do with cash. Accountants don't care about cash, they care about the truth of what happened last year. But you know what? Business people don't care about what happened last year, neither do they care about truth, actually. What they care about is the pot of gold at the end of the rainbow, the future, basically. And the pot of gold is always cash. It is never an accounting statement. You can't do much with an accounting statement, as I said. The fact is, accounting is not finance. And most CFOs in the world today are not finance people, they're accountants. Net result is that they have the attitude of an accountant, which is to look at the past and present a good picture, a true picture of what happened last year. But the fact is, what happened last year is not important. Going forward is more important. And for that, it is the future and cash that is important. Without cash, you cannot go forward, no matter how good your accounting statement of last year is. Myth number two is a related myth. This myth says that it is the margin that is important, not the profit itself. If you think about that, this is an absurd kind of statement. The margin is only a number. The profit is actual money. Which would you rather have? For instance, if you're looking at profit, you make so much profit, $100, whatever it is. $100 is $100, whether it's a 1% margin or a 25% margin. $100 is $100. Would you not rather have $100 than nothing? Even in the example of IT companies who do offshore business and on-site business, I always find that they tend to shy away from on-site business because the margins are lower. But you know what they forget is that the margin may be lower, but the absolute profit is higher, isn't it? After all, if you're looking at making a 20% margin on a $100 rate, that's $20. If you make a 40% margin on a $35 rate, that's $14. Now, which is more, 20 or 14? We all know the answer to that one. And yet, people talk as if having on site business is bad. To my mind, that's absurd. On site business gives you a dollar. A dollar is a dollar is a dollar. We should be happy with that. In a subsequent video, we will explore other myths about finance that we have noticed in working with companies and in real life. Three more myths here relating to debt financing and foreign exchange risk.